Today, our latest mortgage stress mapping. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. I have a number of requests each month for a quicker summary relating to mortgage stress from our modelling. And whilst it's covered in our live stream, it was covered last Tuesday, and the show was about an hour and a half long, this is an edited version which simply pulls out the main elements from that discussion in a more condensed form. So I hope you find this useful. I survey households. We have 52,000 households in the model, which runs up till the end of November. It's done on a weekly basis, and it's pretty detailed. We look at a lot of information coming in from all sources, including our surveys, and we can slice and dice the data all sorts of different ways, looking at across the geographies, property status, household segment status, all of that stuff. And we can also then put it through our core market model, and that core market model then drives some of our scenarios. We'll touch on that a bit later. In other words, how might the economy play out later? What does it mean in terms of interest rates and mortgage stress, those sorts of things? And so it goes on, really. And I will just make the point that the core market model powers our own price scenarios. So we take the mortgage stress data, the price trajectory and history data, the buying and selling intentions, and the migration statistics, other economic data. We bang it all through the core market model, and that of course includes all the scenarios, and we can then create some information down at the postcode level. Now, before I get on to my mortgage stress, Canstar released their surveys, only 2,124 surveys, but I suppose it's better than nothing. And basically they said mortgage stress is going to rise. 47% of survey respondents anticipate slower price rises. Only 12% see those measures improving. And 23% of Australians are expecting to see an increase in foreclosures and mortgage stress, etc., etc. So it does look as though some people are beginning to wake up to the fact that things are not quite as buoyant as perhaps everyone in politics would want you to believe. And Steve Mickenbecker from Canstar and I discussed last Thursday a dose of financial wisdom. I think it came out on Friday, actually, thinking about it. And that's worth watching because he made some really interesting points there about what's really going on. So I recommend that if you've not seen that show, it's worth going and having a look. Now, my mortgage stress, it's a tad lower in November. Now, just to define a tad, it's a smaller insignificant amount according to the dictionary definition. So we've got mortgage stress at 41.2%. Now remember that I define mortgage stress in cash flow terms, money in, money out. So it's not the same way as Hilda does it, or indeed the way that Canstar does it. It's looking at very much at cash flow, not a set percentage like 30% of income going on the mortgage. So it's still very high, and comparing it with pre-COVID, where it was at 32%, we're still at 41%. So there's a considerable rise and move there. And if you compare that with the household debt ratio, which is going up again, you can see that we have a bit of an issue. Now, if I just move that on quickly and just show you that the yellow areas are areas where the stress levels have risen in the last month. The bluey ones are where it's dropped, and so you can see there that mortgage stress has risen in the ACT, New South Wales and the Northern Territories. It's fallen in the other states to give us a 41.23%, which translates to 1.5 million households in mortgage stress across the country. Overall number of households are more than 9.5 million. Rental stress has been rising in the Northern Territories, Tasmania, Victoria and Western Australia. 40.95%, that's higher than last month. And investor stress, a little bit higher in Queensland, South Australia, a little lower in some of the other states. And that's because we've had quite a lot of shift now in terms of people renting. Some people have moved to cheaper renting, and some people also, of course, have now got more hours than they had previously. And the overall financial stress metric has risen in a number of states: ACT, New South Wales, Northern Territories, Queensland and Victoria, but it was lower in South Australia, Tasmania and Western Australia, and the overall number was a little higher. Now, that is a quick summary of what's been going on. So we're seeing a patchwork quilt again, as you perhaps would expect at the moment, between all these different metrics going on at the moment. And we can look at it by segment as well. And again, I've just highlighted the most significant numbers. These aren't necessarily up or down from last month, but the big numbers are young growing families in mortgage stress, including a lot of first-time buyers. A lot of people on the edge of town at 72 and 63%. They're in the urban ring. They're often people who've bought into the high growth areas. Then if you look at rental stress, we've got more mature, stable families and a lot of multicultural people, so first-generation Australians who are renting. I've got issues, as well as young affluents and young growing families. And then investor stress is pretty high as well, particularly, and this is very interesting, top end of town, exclusive professionals, got multiple investment properties, some of them aren't performing, and young affluents, 50.69% of affluents have issues. And if you look at financial stress overall, again, across the different segments, quite a few segments are actually experiencing issues, but some of the more affluent households, again, are actually feeling it. So one of the things I always say to people is don't just assume that mortgage stress is something that lower socioeconomic groups or the urban fringe are being impacted by. Stress is actually hitting different segments of the population. And overall, these are quite concerning numbers, I think. Now, if I then quickly go on to the next part of the story, which is just quickly on the postcodes. So this is mortgage stress. The top postcode this time around was Campbelltown, places like that. 2560 with more than 10,000 in mortgage stress. These are the numbers, the count of households. And it's also highlighting that Liverpool is number 2 at more than 10,000. And then we go up to Queensland, Toowoomba, and the area around there, all more than 10,000 households. Then we go to WA. And then we go to a number of Victorian postcodes, including Narra Warren, Berwick and Harkaway, and Sydenham, all high-growth corridors. And then we go out to Ballarat in Victoria, and then we go to Cranbourne, and then we go to Pakenham, then we go to Hoppers Crossing, and then we come back to New South Wales down towards ACT, and then we go across to WA. So you can see there how the numbers stack up. Very significant numbers in those postcodes. A lot of those are high leveraged households on the urban fringe with a lot of new development. Now, if we look at rental stress, the postcode with the largest rental stress count is Victoria 3,000 in Melbourne, 14,000. And then we go to Toowoomba, and then we go to Liverpool and Campbelltown in New South Wales. Then we go to Mount Druitt, and then we go to more New South Wales postcodes. And in fact, Bondi is on this list still. I've mentioned that quite often. Bondi is one of those, a higher affluent group suburbs, but a lot of people paying very big mortgages, very big rentals just to live there and are having difficulty with their cash flow. Surfers Paradise is on the list and a few other places. So a lot in New South Wales, and I noticed that Surrey Hills and Darlinghurst is quite near the top of the list too. Then if we go to stressed investors, so this is looking at it from the investment perspective. So here we're looking at people who are trying to rent their property out, trying to sell their investment property, have got vacancies, are in negative cash flow in terms of net cash flow. And there you can see that New South Wales, top of the list, Wentworthville, Westmead, and a few other places. WA, of course, is on the list too. Surfers Paradise, Melbourne, St Kilda, in Victoria, South Yarra, Darlinghurst. So what's interesting, quite a few of these are not necessarily just on the suburban fringe, but some of these are closer into the city as well. And a lot of those are to do with high-rise and to do with apartment rentals that are actually still struggling. And until the migration really changes, that's not going to change anytime soon, I think. And overall financial stress, which is the aggregate measure, so it's basically not just an add-through, it's actually a re-optimized series. But you can see there that the financial stress is highest in terms of count in a postcode in Queensland, 4350 Toowoomba. New South Wales is then the second, that's Campbelltown. Then we go to Liverpool. So those three are where a lot of the issues are. Then Victoria, Melbourne 3000. And then we go to Lethbridge Park in New South Wales, Hoppers Crossing, Point Cook and Derrimut in Victoria, Cranbourne, and then we come back to Wentworthville. So you can begin to see the same patterns, I'm afraid. And I'll also highlight down the list here We've got the Central Coast, North Gosford is there as well. Then we have more high-growth suburbs like Fountain Gate and Narrow Warren. And so it goes on, and Ipswich down the bottom. So that gives you a bit of a flavour of what I'm seeing. Now, I can just briefly, before I take some questions from the audience, just go and show you a few charts here. So this is the mortgage stress for New South Wales, centred on Sydney, and you can see there this Western Sydney splodge of more orangey red colours. That is where we see the highest level in New South Wales. And if you drill into closer in, you can see that as you drill in, there are areas which are also showing some signs of difficulty, but relatively speaking, the really big totals are out in Western Sydney, Blacktown there, as well as Liverpool and Campbelltown. Now, if I then just do a quick search, we could perhaps go to Victoria, for example, and just have a quick look there. And again, all I want to highlight is that as you pull out and begin to see some of the suburbs that are in difficulty, it's the same story, that it's the high growth corridors where a lot of the issues are. So here over towards the western side of Melbourne, as well as down towards Dandenong. And as you pull out further, you can see more of that coming to the fore. And then if you pull out a further till, you can start to see some of the other areas further out as well. So there you go, that gives you a bit of a flavour. And what's interesting again is that you see to the north, to the east and to the west, you've got these pockets. And a lot of those pockets are actually relating very much to the high growth corridors. Okay, I'm just going to put one more in here. And then if you want to get more map information, put in the chat and I'll look later. I'm just going to Perth. There you go. Okay, so we're now over in the west. And as always with Perth, it's a bit of a hodgepodge as well. But as you pull out, you can start to see that there are actually some suburbs, particularly to the north and also to the south, high growth corridors where you start to see signs of difficulty. And it's really not much change over the last few months, because whilst there have been some areas that have improved somewhat, there are still many people who are highly leveraged. And I'd remind you that in Perth, a lot of the households have been very much seeing no growth in value since 2010-11, which is a long, long time. As I remind you, my scenarios are a way of exploring different futures. It's not trying to estimate precisely what's going to happen. I'm not making predictions. None of the scenarios may be right, but it does try to give you a bit of a sense of what may happen ahead. And so in that context, there was this slide from Westpac which made the point that monetary policy expectations are now indicating rate rises. These are the different banks: the Fed, the little triangles, the Bank of China, the Bank of England, the ECB, the Bank of Japan, the Reserve Bank of New Zealand, right up there at more than nearly 200 basis points or 2%, and the RBA. And this is the RBA trajectory. So this is what the monetary policy expectations from the market. This is basically what the market is thinking is going to happen. And according to those rates, the RBA is going to dramatically outpace the Fed in terms of tightening, despite the US having a 1% lower employment rate plus double the wages growth and CPI. And of course, those 5 RBA rate hikes over the next 18 months, they're not going to smash growth, are they? They're not going to sort of do anything to house prices, are they? Which is absolute rubbish. So this is the problem I've got. There's a massive disconnect here between what the markets is saying is going to happen and what the Reserve Bank is saying is going to happen, which makes it very difficult to try and actually work out scenarios. But anyway, RBA and markets are in a different place. Markets are saying by middle of Feb 23, we'll be 125 basis points higher than where we are today, which will put rates at around, 2%, maybe 1.5%, give or take. Now, here is my scenarios. And I just want to make this point. My baseline for the next sort of 2 years or so, 2 to 3 years, is basically about 1.5%. I think that's probably where the RBA will be, which is more aggressive than where the RBA says it's going to be, but it's not as aggressive what the markets are saying. And 4.75% unemployment rate is certainly conceivable. And if we get there, then we could see home prices probably moderate, not dramatically so. There might be some that rise slightly, but it's basically the end of the big boom in prices and probably a bit of a fall. I give that a 10% rating. My base case, this is what I think is most likely to happen at the moment, is that we probably will get small rate rises, only about 1%, and unemployment rate will be slightly higher, the mortgage stress will be higher, the losses will be higher, and home prices will be down a bit, so down 20% perhaps, or depends. Units, houses will behave differently. I give that a major probability. And then if you go longer term crunch, then you've got these other scenarios which are more drops but less weighted. But the problem I've got is it's hard for me to see how you can actually run a scenario with stronger interest rates. So if you put the interest rate up to say 3% or 4%, the cash rate, you would immediately see mortgage stress go up towards 50%. And you would immediately see house prices fall by 30 to 40%. And I don't think that's a valid scenario at the moment. I can't see how that can conceivably happen. So the Reserve Bank, I think, is caught with these low rates. So that's why I have not done a scenario that actually is projected with higher interest rates than the 1.5%, which is what the Reserve Bank is saying. Now, I can do that scenario, but I just don't think it's conceivable at the moment, unless we see all the other central banks around the world lifting their rates significantly, and then because of the exchange rate movement that would actually be created against Australia, the Reserve Bank would have to respond. Now, that is a scenario, but at the moment it's not one that I actually think is very likely on my central scenarios. I incorporate this information then in my modelling, which then allows me to talk about individual postcodes and locations, if I want to do that. I also just will mention again the DFA one-to-one service. We do have the ability to have a one-to-one conversation with people about a particular suburb, and sometimes it's quite useful to have a confidential conversation about a suburb. I can't give financial advice specifically, but I can tell you about the specific trends at a postcode level, which can be quite helpful sometimes. Look at the underlying trends and also where things may be going. I can look at the stress, the home price data, and the other information from our surveys, and based on our modelling we can create a view as to what might be going to happen. You can book a time, Zoom or phone, whichever, about an hour or so. There is a cost involved, and we are running about 3 to 5 weeks ahead in terms of booking, simply because we've got quite a few people who want to chat about things at the moment. Things are quite uncertain, people are looking for different points of view, and so we find these one-to-one service are quite useful things to get involved in. So just to summarise, we are seeing continued issues with regard to mortgage stress across the country. And I'd also make the normal points that I do. The first is that many households are still not really fully aware of the financial pressures that they're under, not least because they don't often maintain cash flows. So I do think it's important that households know where money's going, money in, money out, and specifically how they can address it. The second is once you have a cash flow, and if you want an example of a good source, go to the ASIC Money Smart website. Once you've got a cash flow, you can then prioritise more effectively. The second point is that I don't think we're going to see significant wage growth ahead, which means we don't have a get out of jail card for those people in financial pressure. As a result, unless you change your behaviour, things are going to get worse, not better. And of course, we now have the prospect of higher interest rates ahead, although, as I discussed earlier, maybe not as quickly as some are suggesting. The third point I'd make is that if you are in financial difficulty and you've got a mortgage in particular, it's very important to talk to your lender early, because they do have an obligation to try and assist. Now, some of the options they put on the table, for example, extending the mortgage or refinancing, may not necessarily, though, be very appropriate for you. So it is also important to get independent financial advice if you are in financial difficulty. And whilst I don't provide that personally, there are entities and organisations out there who can assist. But the point I'd make is this: if you are in financial pressure and you have significant pressures about meeting those mortgage repayments, act early and get help, because otherwise the pressures which build over time can be frankly extremely destructive. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.